Welcome. Good morning, and welcome to the live edition of the Rick Helps Real Estate Show this morning. And trying to make sense of this crazy Arizona real estate market. And today it is definitely getting crazy and crazier. And as I said last night, we were going to check in and see what's moving, what's not, what's the impact of this collapse of the SVB Bank up in Northern California. And so we're going to take a look at some of the numbers this morning, see if anything's moving and what does this mean. And right now, we're seeing that the Fed's new backstop shields banks from $300 billion in losses. So they came on and said that they were not going to bail them out. So the Treasury's not bailing them out. But the Fed says, don't worry, we got your back. So not sure what the difference is. We're not writing them checks. We're printing money for them. So going to be interesting to watch. But what's moving today? Well, take a look at gold prices. They rocketed up and they're still going up. They came down a little bit yesterday. Then they announced these stopgap measures and gold went up again. We're actually seeing Bitcoin have a heck of a rally, flying up like crazy. And there's commentary here that says FVB's rescue means the Fed won't hike rates in March, says Goldman Sachs. Interesting. The debate just a few short days ago was, are they going to go up 0.25 or are they going to go up 0.50? Because after his testimony, he said, everything we're working on doesn't seem to be working. So we're going to have to kind of stay the course, if not tighten down even more. And right now, take a look at what's going on with treasuries and to understand what's going on. Good morning. Buenos dias. Going to bring in our resident rate and bond expert and our mortgage guy, Mr. Pat McMasters. Pat, what's my rate? What's going on?
Well, good morning. It must be a special event if I get my butt out of bed.
Yeah, you need to share your screen too if you're going to share a screen.
Yep. Let me roll that here. I apologize. Give me 1 second.
I rattled your cage early this morning.
Yeah, you rattled my cage this morning, but okay, you got to get your butt up and we got to roll here. But I'm sure I'm not the only one up. I'm sure the Federal Reserve is up too. I'm sure they got
they're still having their emergency meeting at 11:30 Eastern Standard Time.
Yep.
So it's probably going to go on a couple hours, and then we'll hear some chatter about that. But so what's going on with rates this morning? Let me pull up your chart here.
Yep. Rates are having a good day, up 95 basis points. On the 5.5 coupon, the U.S. Treasury is down 22 basis points. We saw it hit 3.4, right about 4. Obviously, about a week and a half ago. Now we're at 348. You see the chart. Here's rates. This is basically I'm pulling it out 6 months. You can see where we're at. We're basically back to the levels of February 3rd where we started this move. So this whole move right here has been obviously. We've seen gains, really good gains. Where does one start? It's like I said, this morning I got up and I'm like, okay, where do we start with all this? Because there's a lot of information rocketing through the markets right now, and there's still a lot to shake out still. I mean, obviously SVB, they're blaming management, but is it bad management or is it the Feds, causing this too? Obviously there's probably a combination. Just goes to show you some of these guys, these Harvard MBAs, I always kind of say the theory is if everybody's so smart, we wouldn't see such gyrations in the market because somebody would see something before it happens, if they're really smart. But
this was the 16th largest bank in the country. And it's very interesting that, just a week ago, we weren't even discussing this, and it shows you how quickly things change. Just out of nowhere, Friday.
Remember we talked, you and I talk about that. We were just kind of muddling along. We saw the movement in rates. Excuse me. And all of a sudden we see this, and I think you and I have always said, there could be an event, there's that caveat that something could happen. And like I said, I think, if you see one rat, there's probably gonna be a few more rats out there possibly. Cause I think it's obviously, this has a lot to do with the Feds. Basically what they're saying is, the underlying, failure was obviously a problem. And it's, basically this one I read, basically kind of I've been doing a lot of digging here recently, obviously this weekend, but the problem with, SVB, Silicon is that, they had invested their deposits in low interest rate bonds and they held them on the books, what they call hold to maturity basis. Basically, that means that they don't mark to market any of those bonds until they're sold, because mark to market basically means you market where the market is to a certain degree. So that left investors, obviously there was a distorted balance sheet out there, and as long as the bank doesn't need to sell those, but the problem is, they had to sell them, and obviously that's when things got complicated. But another thing is too, with the Feds raising rates like they did, short term rates, the inverted yield curve, basically they're handing out money, 4.5, just throwing numbers out there, and that causes a problem. As far as the gap, it was like 120 basis point gap between short term and long term rates. So
Well, Sean's asking the question. So what's this mean? Lower rates or higher rates?
well, right now lower rates. I mean, the Feds. I mean, you know, you and I are just two guys in Phoenix trying to figure this out. And the Feds are, honestly, I think the Feds are trying to do the same damn thing. I mean, they got a lot more on the hands, and we got it. We got it easy. We can kind of sit back and take a look, but there's a lot they've got on their plate, because obviously it takes the 25 or 50 basis point that changes that whole scheme of things. And this kind of goes back to what Barry was saying. He's been a big proponent of going against the Fed, and he says they don't really know what the hell they're talking about. And he's said he said last week and Friday, he said there's cracks, with the employment numbers, and he goes to academia. They're looking at things kind of the wrong way. So,
well, they put out a list of 20 banks that may be in the same situation. I'm thinking, oh man, that's talk about sitting at home going, my bank, I guess I'm going to go there Monday. So today is going to be very interesting, but they've all but guaranteed the deposits in this bank. I don't understand banking, so I don't know how they do that. How the Treasury is not sending them any money, but the Feds just said, we'll just lay some reserves over here for you. You'll be fine.
Well, a lot of it has to do with, there's a lot, not just cash, but the confidence in where it's going to be. They have to obviously throw that confidence that everything is going to be okay. This is an event. I mean, like,
well, it must be working. Here's the Dow Jones is up 161 points.
Yeah. So that kind of tells you that the market says, okay, this is an event. There's a lot of events you see these events, whether it's a hurricane or tornado or financial 08, the things, we have these events, and then you get this commotion, and things kind of just have worked themselves out. I think, I'm sure you get the doomsdayer saying this is just the start of it.
Could this be a smaller or larger version of the savings and loans crisis that really disrupted banking for a while? Or is this just it's kind of hard to look at this and say, well, it's just isolated to a few small banks, when the same math equation applies to every bank out there.
That's what I mean. It's just that's why I think there's going to be probably more, because it really has to do with the Feds raising rates. Like I said, banks took that money. If you think about it, they invested that money, at say 2%, and now rates are at 5%. What do you do?
Yeah, I mean, so you've had interest rates down for so long. When banks get a deposit, they have to do something with that deposit, right? I'm trying to get as much grade school as I can for me.
Yeah.
So when they get the deposit, they have to buy an asset, or they have to loan the money out.
Yeah, so that's how they make their money.
They loan the money out at a very low interest rate, and they buy treasuries at a very low interest rate. Now the rates go up, and those holdings that they have are worth less. So that's not just limited to SVB. And Timothy here says, have you guys seen the FDIC meeting video from a few months ago? They admitted it's all smoke and mirrors. There's not enough FDIC funds to cover a large bank run. Today is damage control. It's kind of like Social Security. We don't have enough Social Security to cover everybody that's going to retire. Everything's all smoke and mirrors.
Well, it goes back to, that's why they got to get this budget under control. You got 31, $32 trillion. They're paying, this, on that interest on that enormous debt. That's a big problem too, so they got to get their fiscal and monetary policy aligned together. And this, they're not doing it right now. There's a combination of a lot of different things, they're spending money and the feds are tightening, so it's like,
yeah, in fact, in the testimony from Chairman Powell, the last time he had his news conference, he finally came out and said, we can't continue to tighten while the Treasury continues to spend.
Yeah, yeah.
And they tried to rope him in a little bit when they had him in front of the Senate talking about congressional policy. He snapped at him and said, that's not my job.
Yeah. Yeah.
So
you've got a lot of competing, until they get on the same page, we might have this, like you said, these guys are spending like drunken sailors and the feds are like, no, you can't. So there's a lot behind that scenes too. So, it's not just one thing, there's some interesting.
Is this quantitative easing once again? What are we looking at?
They stopped, they haven't been buying, certainly that could come back in the forefront. I think that's why they stopped, so they can, two things. I think that's why they raised rates, so they can have bullets in their gun down the road. They did the right thing, but it's kind of like you stop drinking after 50 years and your liver's shot. It's not going to help. It's you've already shot your liver. It's like, oh, I'm gonna stop drinking. Well, sorry, buddy, you're done. But then they got the quantitative easing, which they haven't been buying. So who knows? Maybe they come back and tip that scale a little bit too. This goes to show. I'm just going to show you. Just from a, the problem is the average home buyer. You're going to see everybody reading one article and saying, "Oh, I can't buy now," or you're going to have all types of opinions. But back to now, you can blow up my chart, right? Go up to my.
Yeah.
You're going to be able to blow this up, right?
No, not while we're live. I'll have to do it in post.
Okay. Here, let me. I'll just try to. Is that better?
Yeah,
let's just give you an example. This is one of my one of my deals. I'm looking at. Basically, I just ran up the scenario, and about a week and a half ago, you were looking at 7 1/8, 7 1/4. Basically, you're looking at a payment of $4,076, say it's 7 1/8. But today, about a week and a half later, we're looking at 7 3/8. So that is a difference of, since I'm pretty good at math, but let me just make sure that I'm dialed in here. $3,575. That's a difference of $351 a month, monthly payment, in about a week and a half. Yeah. That makes a big difference for somebody looking to buy.
Well, it's a sad story if they locked last week.
Yeah, actually, I had a couple of people I locked because they wanted to, but I told them, I actually held some people off because I'm like, let's just wait for Barry, March 10th, March 14th. Obviously, Barry didn't know this was all going to happen, but he's looking pretty good right now.
Well, I would like this chart here too. Take a look at that 10-year Treasury yield candlesticks. Bam,
yeah.
Bam.
Yeah, you're starting to see it broke through the 200-day moving average right now. We tested it today. It was at 345. Was the 200-day moving average. So we're at 350. It did touch that this morning, but the 200-day moving average is going to be a tough floor to bust through. But if it busts through, the next floor of resistance is 322 on the 10-year bond. So that's another, 28 basis points down, which could be another point in bonds, give or take.
Trying to get my red pen to work so I could circle where you said 322, but it's
yeah, you see that Well, yeah, there's 342, three. That one's I don't know what that one is, but I'm looking at my chart. So,
Yeah.
but so it's the problem is too, Rick, is that on my side, I had a client say, well, lenders are going to drop their rate exactly. They're down 80, 75 basis points. They're going to drop them 75 basis points. Not so fast, because lenders. The problem is, and we've talked about this in past chats, is that remember back in 20 when we had the volatility, when we saw 3 or 4 rate changes, 5 or 6. I saw back in 2020. I actually saw some days where we saw 5, 6, 7 rate changes. It was changing so much, and the problem is that the lenders, when you get this type of volatility, uh, based on my experience, is that lenders are not going to give back or give that gain. They're not quick to give it because you got the markets volatile. If they give you an example, they throw out $400 million of they lack $400 million of bonds at 4, but rates kind of move back up again during the day. They've locked $500 million at 4. It's not 4, but 4 to 4 and an eighth, 4 and 3/8. That's huge margin. So they're not as quick to pull the trigger. It's kind of like gas prices. When they fall, they don't fall as fast as they going up. They'll go up a lot quicker than they fall. And rate lenders,
That's the same with food.
yeah, I mean it's so they will give some lenders will. It's really lender by lender, case by case basis with lenders because some are willing to give you the gains a little bit quicker than others. And the beauty of, like I said, being a broker is I've got 50 plus different lenders I can go to, and if rates change, obviously lenders don't like this, but you can do a float down, or also sometimes just flip the darn loan to another lender. And if I was at a retail bank, once you lock at a retail bank, you're pretty much locked with that institution. And then if you move it, you got to pull credit again and blah, blah, blah. So that's the beauty of being a broker. You got a lot more flexibility.
Well, we got
So,
a question here from Lou. Could the drop in rates positively impact inventory, or will this continue to spur more buyers and shrink inventory? That's been what we've been trying to track to try and figure things out because, right here, the blue line is number of new listings right now. The banking hiccup that we're in right now is nowhere going to be included in any of these numbers. This is just 7-day moving average, but new listings have continued to go down as rates continued to go up. And new contracts have been trending slightly lower by about 200. Now, if rates get really low, of course we would expect the buyer, and when I say really low, let's just say 6.2, which is way lower than we were last week. Will that mean more buyers? Yes. Will that mean
yes.
more inventory? I don't know.
Yeah.
Because maybe not. And that's where I did the video last week that said, are we facing another shortage? Because you're still sitting there at a 3 or a 4% mortgage, and you're not going to want to sell and then buy something that's 6.2. Although 6.2 for a buyer's far more attractive than 7.1, but it's not attractive enough to make you list. So all we can do is just watch where the rates settle and then see what's going on with the inventory numbers because it's so hard to predict right now.
Well, that goes back to if you're a buyer or a seller. Yeah, obviously a buyer, you're looking at chomping your bit because I said you're just based on the numbers I told you, your average payment in about a week and a half went down. Let's call it $300, which is huge. That, and that's what you and I have been talking about, rate drops versus home value drops because, I haven't had time to figure out the numbers, but okay, 300, maybe we can come up with this number, but what does this $350 a month reduction in payment, what does that look like in a home value drop? Does that mean a home went from, say 500,000 down to 440, or what I'm saying?
Yeah. Well, the challenge that we're seeing too, though, Pat, is that the list pricing is not going down.
No. We still have we still have the inventory problem. If
yeah.
once again, if we have this surge of buyers, you're still going to have this inventory because once again, it goes back. Remember, we've talked the last several months about And I started to see this phenomena, you know, as like I said, you see phenomena as develop as you watch the market. Like you and I have been watching it closely the last 3 years, and I think it gives us some credibility as far as what the heck's going on because we're watching the whole game, the whole day, the whole game, not just one or two, three plays in the game. But this volatility kind of freezes people too because they don't have maybe if they do settle down, we get all this volatility, but then they finally settle. You're gonna have volatility for the next couple days, next couple weeks, whatever. But if they do settle into a range for a bit, then you're gonna see, I think, people like, okay, the storm is, let's because they can't make a decision based on what's gonna happen next 30 days listing a home. I don't know. I mean, it just they need some
Yeah,
type of
this is
stability.
gonna be tough. I mean, what kind of decisions are gonna be made this week,
Yeah,
by the Fed? I mean, that they're having that emergency meeting today, and they're going, well, there went the 0.50 increase, gang. Now what?
yeah. I think that's
And
off the table. I mean, I think that's off the table. I mean, I think worst, best or worst, whatever you want to look at, maybe a quarter. But even then, they might just pause. Boy, I tell you, it's anybody's guess.
well,
I don't.
Goldman
I
Sachs jumped out here and said this. They go, nervous investors may be wary of more shoes dropping following the Silicon Valley bank fallout. And no rest for the wicked as the next updates on consumer prices come out. So I kind of clicked the mouse where I shouldn't have right there, but they're saying in the midst of all this, the CPI number is going to show up. So what if we get a bad CPI report at the same time where the banks um,
yeah,
need more liquidity? I mean, this is going to be very interesting to watch.
yeah.
Congress can still stop the Fed. They won't, Jason. They just won't do.
No, no.
Jason,
The
yeah,
feds are,
Jason, I agree with Pat. My team's met with dozen potential sellers the past month. All are in frozen mode due to the volatility. Everybody likes certainty. If you're a trader,
yeah,
though, you're loving this week. You
yeah. I
love
mean, there's some
wild
traders that
swings
love
if
it.
you're an option
Are
trader.
are some right now are drinking a gallon of Malox.
Yeah.
You know, so I mean, yeah. I mean, I think it's for the right person. Obviously, it does create times like this do create opportunity for some people and create headaches for others. I mean, you have to kind of step back and once again, you got to look at your individual case of what how can this affect me positively or negatively, and you can't, like you said, the average person shies away from this and they just say, hey, I'm not going to do anything. I'm just going to sit tight for a while. You know,
Yeah, and
um,
there's a lot of articles I'm seeing out there now that are kind of showing and saying, buy this bank stock, watch it and see what happens. But
yeah,
here's the new listings, average list price. Look where they're at. They came up. We're just following 2022, which is very puzzling that we're taking that path. Now, I've said again that um, um, they're listing at higher prices so they can give away more. Give you more concessions. Um, well, the student loans and bank bailouts are kind of student loans. You can still have those hanging out there. It's not going to collapse the market, but we could debate that all day. Jason likes your what makes you say Congress won't stop the Fed? I don't think they have the stomach for it. In other words,
no, no.
they're not. There's
And the Fed's not going to allow them to do that either. I mean, they're crossing the line. You know, I
Jerry,
mean,
you're
I
but check this out. I mean, are we really? I don't think our average list price is going to march up to what we saw at the peak in May. Um, I would hope not. But then again, I'm looking at the Chandler CMI and it's over 200 now. It's like, what the heck?
yeah.
So, um,
I
so
think the underlying thing is that we see this short term volatility with rates and demand, and the underlying thing is we still have a lot of demand out there for people looking to buy a home, and we still have an inventory issue. You know, that's really the bottom line. So it's insane. I've never seen a time frame like this.
Friday was just so interesting to me.
Yeah,
I just kind of saw that and thought, wait a minute, what's this going to do? And then Saturday, I started watching all. They basically came out on Friday, and Janet Yellen said, "Well, we're not bailing you out. We're drawing a line in the sand. We're not doing that." And I go, "Well, I wonder what the weekend's going to bring." And then here comes Sunday afternoon, evening, and now they have a plan to help everybody. It changed from Saturday morning to Sunday evening, and
yeah,
I thought this is going to make Monday really wild. So, Jason, I feel like if we could settle at 5.5 to 6 for a few months, sellers will go back to some degree. It's going to have to hang for a while. I think I agree with both you guys that, sellers are. I mean, imagine this scenario based on the volatility we're seeing today. I sell my house today. Rates get down to, I'll
yeah,
just make it up. They get down to 6.2. And then by the time I close, they're 7 again. You
yeah.
know, I'm
That's
sitting at the kitchen table going, no, dear, we're not doing this.
well, that's it. I mean, you pull back. You can look at all this noise, but I pull back to the average Joe. Barbara and Joe Smith. What they're looking to do, and they're sitting around the kitchen table, and like, what should we do? Like, well, what if interest rates are? I think the average guy's pretty smart. Like, what if rates are drop down? But what if they go up in the next 30, 40 days? And they can put people in a kind of a squeeze.
Yeah,
You know,
yeah.
so
Renee here said she was in Buckeye, saw a bunch of new construction. That's where all the new construction is. But you know what? And says they have new pricing, and they have lowered their pricing from their May peak pricing and their January peak pricing, but they don't seem to be in a pinch. And you start looking at how many people are moving out to that area. It's staggering.
yeah,
It's just, and the number of new permits has gone way down. So there isn't a whole bunch of building coming behind it yet. So, but if you've got um, more lower rates coming and sales pick up, those guys are going to be fine. Anytime you slow a Ponzi scheme down, it will crash. It relies on continual perpetual spending and debt growth to keep going. I've long said that the fuse for the debt bomb has been lit, but I don't know how long the fuse is. I mean, the debt that we have and the results of that is going to be bad, but it may not be bad. We can kick this can down the road another 10 years.
yeah,
I
yeah.
mean,
We have been the last 10, 15 years, but it's got, but exponentially, it's gotten so bad the last. Trump obviously, the last several presidents have not helped the cause, and you see the debt, exponentially move. When was it? It was under what 18, 19 trillion. Now we're talking 31, 32. It's gone up 50%. And how I don't have the time frame.
I heard a number yesterday. It's 119% of GDP. I think it was 125, 128. The difference is
mhm.
the last time that we had that level of debt was in the 40s after the war. But we ended up being the only country that still had manufacturing left. So we were able to gear up and get going while other countries had to rebuild their factories. So we were able to pay down our debt with economic growth. Right now, what do we do? It's a whole political debate there. It will be kicked down the road. The road will be paved with high inflation. Yeah, it's hard to look at this now and say, well, we solved inflation.
Yeah.
I
Another thing
don't
is
know.
too. I think just this is just Pat McMaster's good old Chandler boy, Wisconsin boy talking, but I mean, no,
Here,
I lost my train. Hmm? Yeah.
have a re-
No. Anyway, it's it's going to be interesting. It's going to be.
well, I think the most of the changes that we're going to see, I think now, is going to happen between now and Thursday because the CPI report is Wednesday, right?
Yeah, yeah. No. I think it's. I gotta check what date it is. I think the 14th tomorrow.
Oh,
I think is.
tomorrow. Holy
Yeah,
cow.
yeah. I believe it's tomorrow. I mean, I double check. I mean, I've got so many numbers running through I got so many train tracks running through my head right now. It's just. I mean, it's getting busy at the terminal station.
Well, you know, I, I got that just for you.
Oh my God,
So,
my ADHD is kicking in like full time here.
so every lender in the country right now is just sitting looking at their monitors, going, "This looks good. I don't know how long it's going to be good. I don't know where it's going. Do I lock? Don't I lock?"
Yeah,
You know, and they got their bottle of scotch right there, and
yeah.
so
Well, being St. Patty's Day, St. Patty's week, you got to get ready for that for Friday.
that's right. That's right. And I hope I hope you had fun during the parade. I forgot to tell everybody to go to the parade, and if they see you, go, "Pat, what's my rate?" So,
I'll
so,
send you a picture so you can post it. So
sounds fun.
probably took about in a 3 hour period. I probably took at least 600 photos with people. I couldn't walk 5 feet with people tapping me on the shoulder saying, "Hey, St. Patrick, can I get a picture with you?" So
I'll see. And then nobody
I had
wants to talk to you when you're not wearing that outfit.
I had this I had this one girl that I went out with yesterday. I go, "Did you see me?" I was so proud. She goes, I go, "Did you see my St. Patrick day?" She goes, "Yeah." And she was kind of like, "Hmm." I go, "Really?" She goes, it's
It's not
different.
it's not
It's
doing
not
anything for me.
it's not doing anything for me." I'm like, "Everybody else loves it."
Yeah, well, let's just put it
Yeah.
this way. It wasn't your magic Mike moment. So
No,
you know,
no. So very true. It was not a Magic Mike moment. No, very true.
well, Pat, I'm gonna be on tomorrow morning at 8:30 again. I'll be going over more real estate numbers
I'll see what I don't know if I keep
in
getting up this
detail.
early. No, I do get up early,
Yeah,
but
I don't know if I do it to you 2 days in a row. So I feel like
yeah,
I need to
yeah,
come.
yeah.
And
I might have to go to bed tonight
yeah,
early and get up. So,
bars will
but
be packed with lenders on St. Patty's Day.
yeah, no
Yeah,
kidding. Well,
this
it
is
always is anyway.
yeah, I know. Yeah, the realtors, we're going to be sitting right next to you. So
Yeah.
we weren't expecting a lot of volatility this week until we get the CPR report. Now we're expecting nothing but wild, rampant volatility, and we'll keep everybody posted right here. It's hard to predict anything going out even a month now. I mean, all we can do now is just watch and say,
The only,
well,
yep.
here's what happened today.
The only thing I can predict is the sun will set later tonight and it will rise tomorrow morning.
You got it. Well, Pat, have a great day. Everybody have a good week. Thanks for watching. Take care.
All right, brother. Take care.